All right, good morning. Green on the screen around the world. Risk on. Up just a little bit in the indexes. China's down most. Japan is just past the zero line. And the NASDAQ in our markets is dragging its feet. So either it's an early warning that the others are going to turn around and come back down, or it's the late bloomer and hasn't yet run to get caught up. It's very likely that it's a late bloomer, with Apple news taking it down more than 1%, Apple being a big part of the NASDAQ 100. This is a week of Fed presidents. We're going to have Fed presidents talking a lot today and throughout the week. Every one of these speakers has the potential to screw up, to say something inadvertently moving markets in a way they hadn't intended, and for a reporter to misunderstand what they said, report it badly, and move markets. So it can come from either direction. I know that sounds really generic, or like, a minor worry in the big scheme of things, but it's not. Seen it happen before. It will happen again, and it's usually a flash move. The markets, and especially the algos, will respond to that headline before it's confirmed by multiple sources or anything else. And it's just on the table, right? When you have that many speakers, something to go wrong, it's increased considerably. Tonight, there's going to be some big data coming out around the world. So really know what you own. Think about this in the afternoon if you're thinking about swing trading a day trade that you decided you want to hold. There was a lot of talk about bonds over the weekend, and one thing that I kept leaning back on through the weekend, through multiple people's questions about the bonds, is look, unless you've got a degree, you're not going to be able to see all of the macro and micro pieces to this puzzle, right? There's just too many parts, and there's too many first times happening right now to be able to easily discern what's going on in the bigger picture and if it's the time to buy bonds. Quit trying to bottom fish, quit trying to call bottoms. If this is the low in bonds and we start to run up, the TLT is down nearly 50%. That's half of its price in the last few years from its peak. So, there's a lot of upside for any trades to go long in bonds. If you want to go long in bonds, all you got to do is the same thing that we've always done. Quit treating it like it's something different and just treat it like it's something with candles and price patterns. Look for a bottoming formation. Look for a trade signal and get in. It doesn't need to be any more complex than that. These banks hire professional bond traders, and even they can't get this stuff right, as we saw back in March with the whole bank crisis, right? So just trade what you got. It's really no more complicated than that. And from what I've seen so far, it's not time to go long in bonds. So unless you just want an LRE, low risk entry, just because we're at these, nice low levels, you don't have a signal yet. Here's the spot gamma levels for the day. Just stay there for a second so you can get a screenshot. And for SPY, So Friday, I was having issues with my trading view. It wasn't my trading view. It was my antivirus software decided to suddenly start attacking trading view. Wouldn't let me run it on any browser or from the app, which is why it was working on one computer, but it wasn't working on the other computer. Eight 8:30, 10:30, 11:30, and then some data tonight. We got a CPI out of, I believe that's Australia, but let's see. Could be Asia. New Zealand. New Zealand's got a CPI. All right, let's just kind of start with the week, get some idea of the things that we need here. We can start with last week's range and consider the idea that on this week, how we close on the week is going to be really important, starting with that 50% mark. Now we are gapped up this morning and it's a gap that isn't filled yet. So it's entirely possible that we go down there and we close this gap. This is a weekly gap on the S&P, on the ES futures. And while there are gaps that do exist, these tend to get filled. So 43.50 is on deck at some point this week. If we continue this advance, we've got the 20-week and the 10-week over our head. That's the 20 EMA and the 20 SMA. It's the 10 EMA and the 10 SMA. So one of the things you can do is mark those levels on your intraday chart. If you're on a charting platform that doesn't give you multiple time frame moving averages, just look at the number. We can see that this 20 period is at 43.78.5. So you can just go to your intraday chart, draw a line there, and now you know where that 20 period is on the weekly. You'll have to update it through the day, but it's not going to change overly much, right? We can see how it's fluctuating just a little bit, but the ES moves in ticks. It doesn't move, by penny ticks, it moves by quarter ticks. So these little fluctuations really aren't changing the number. Go back and look at it later today, see if anything drastically is altered, but that'll get you by, right? So you don't need fancy software that has multiple time frame moving averages. You can just snap the line at where they're at. That's going to be a lot of resistance to get through. And we can see last week how difficult that resistance is going to be, because we pushed through 3 out of those 4 and we still dumped it back down again. We are above the weekly pivot point, but we cut through it. So it's like starting from the center of the basketball court. We have the capacity right now to make big moves in either direction, and it wouldn't be overbought and it wouldn't be oversold. We're now getting above the volatility trigger from spot gamma. That's considered bullish above, bearish below. So as generic as that sounds, it tells you that you only want to look for long opportunities when we're above that level, and you only want to look for short opportunities when we're below that level. Of course, for you counter trend players, just flip that around, right? We do have the 20-day moving average overhead as well. So if we continue this advance, again, there's nothing but headwinds going up. I was doing some work on SPY over the weekend, and the SPY call wall is really close, and it's been a fairly difficult level to get through. The put wall's at 425, the volatility trigger or bear bull level 432, zero gamma 437, and over the weekend when I was doing my work, the call wall was at 36. It's now moved up to 40. So 440 is the call wall. If you're really unfamiliar with options and optionality, consider that a significant resistance level. It's an area where there's a lot of selling going on the call side. Now that could be sell to close. It could be sell to open. There's no reason to really struggle with that mentally on, which kind of calls is it. But when we get into that 440, if they've been monetizing the calls on the way up, right, buying calls around that 440 level, and as we get into that area, they're closing them out, then it's just a negative pressure every time we get into that zone, just a negative pressure. Until they move that call wall up, then we just have to think of it as a big selling zone, and that every time we get in there, market makers are selling. They're selling into that call zone. It makes it hard for the S&P to work through that call zone. Same thing on the put wall to the other side, that 425. So it doesn't mean we can't get through those levels, just that there's a lot of anticipated activity at those zones. So it's going to be hard to get through them. Day 30-minute volume profile. When we're at the highs, we expect to go to the lows. When we're at the lows, we expect to go to the highs. Point of controls at 4,400, and we're working our way back up to it. We've got one price shelf here around 43.70. But if we can get through that, then we'll make it to the point of control. And there's really nothing in between those two to give us any grief. We turned back in the middle of a shallow area. I had somebody asking me about this. This is what we came up with on this, is basically that the S&P turned around here, not because the S&P hit a pivot point, but because a correlated or an inversely correlated market, something somewhere else hit a pivot point. Just to use a generic example, say the VIX hit a significant resistance and started to fall, and that fall was the inverse of this rise. Something like that. Now, I'm not saying that it was the VIX, because the VIX doesn't move the S&P. I'm just using that inverse correlation for an example of what it could have been. So the S&P didn't hit something down here. We can see that there wasn't a large amount of buying or anything like that. That's why this volume profile, to me, isn't used for buying and selling. I don't trade because of the volume profile. This thing is for insight. Where's the trading been happening? Where is it likely to happen again? Where's the heavy trading? All right, we got a very narrow IB. The IB is initial balance. It's the open range. The reason we don't call it an open range is because when you do use an open range, you can decide which open you want, and you can decide how long you want it to be. A 5-minute open range, a 15-minute open range, first pivot high, first pivot low open range. Really, it's discretionary. You can do whatever you want. When it comes to the initial balance, we don't do whatever we want. It's 1 hour, and it's at Globex open. Now, there's a newer version of IB that I've seen that starts at 9:30, and it's still 1 hour, but that's a more modern version of IB, initial balance. Either way, it's just a market open, and it takes away the discretion. You don't get to choose. It's just always 1 hour and always at this one spot. When it's a narrow IB, it implies that there's still a lot of work to do, that they could come in and do a lot of trading because they have not yet done a lot of trading. I know that seems very simplistic, but a lot of the trades that we see happen are either algo driven, or they're just some schmuck in an office gets the call and he or she is told to buy X amount over X period of time. and they're just going to go in and feather those trades in. So, you know, it's not like there's some rocket science genius sitting out there, some trading guru who's got it all figured out that's maximizing these trade entries and exits. A lot of these are non-discretionary trades. Somebody is told, buy here, sell there, and that's what they're going to do. CTAs, vol funds, hedge funds, traders that need to hedge, firms that need to hedge, they'll go in and trade these things. So looking at this, the trading has picked up a little bit. I don't yet have a name for this, but it is a very common pattern, almost like a spinning top. When we break it, whichever side gets broke, it usually sticks. If you go in the past and you look for that right there, you'll find previous examples of it. Make sure you include all of these parts right there. We are looking for a Globex breakout here, just tested and failed it. If we get this Globex breakout, then the targets are going to be yesterday's RTH open, 43.94. There's a yearly institutional level at 43.92, so just kind of keep that in mind. It's really close by. I would also target the Globex high of Friday. So at 91.75, that'd be that institutional level. It's really close, 92 something. The RTH open and then the RTH high. You can also catch this low down here, but we've already worked through it a couple times, so it doesn't have a lot of weight at that point. You know, by now it doesn't really have much to it. There is a VPOC, but we've already hit it, so we can carry it through there for the day, which usually it's what I like to do. Even though it's already been hit now and it's no longer a VPOC, we've only barely hit it and it was a Globex hit. It's not like one of those days where we opened up and we just traveled through the zone over and over and over like we did Friday into Thursday's VPOC, right? So this has been hit, but I would say, to me, I want it on the chart today just to see if we do go back into that area, if price does respond at that zone. But it is already hit, so technically speaking, it's not a VPOC at this point. So we got our levels laid out. And this isn't even counting any of the optionality, gamma levels, ADRs, anything like that, right? Globex low, Globex high, yesterday's Globex low and Globex high, the RTH open, the RTH low and high. These are just the normal, everyday, simple, yet very powerful pivot points. Those you should always have on your chart, right? Because they're going to offer you the most bang for your buck in a trade. Now, I mentioned last week that we have the ability now to see an ADR level in the past, which is fantastic. think I moved too fast there. Nope, I'm just impatient. So these ADR levels, they're not exactly in the same spot as they are on Thinkorswim, but they're close enough that it's not going to matter, right? A couple ticks either way. But the best way to understand how to use these is to understand what they're marking. It's the average daily move, right? What we move on a day-to-day basis on whatever market you're looking at. It does begin functioning from the open, so be careful with whatever broker you're using that you understand when, quote, it opens. So when we get to the red line, that is the ADR for the day. It's just the ADR distance from, let's do it on Thinkorswim so I can show you first what it is. Because it'll really help you to understand what it is to be able to use it better in your trading. So I'm on a daily chart. These are daily candles. The entire range from its highest point to its lowest point is being measured. That's one day, one candle. Then it looks at the last day before that, highest point to its lowest point, and that's another candle. And then the next one, and that's another candle. And it keeps doing that until 21 candles have been measured from its highest point to its lowest point. So when we say it's measuring the average range, that's the range that it's measuring. How far from its highest to its lowest point has this particular market moved in the last 21 days? Once we have that number and we look at today, we're asking the same question. Do we think today the price is going to move its same average daily range that it has been running over the last 21 days? And if it has, then from where it opened, it could make that same range. Going a little bit higher, think about where we closed there and we opened here, and what happened? It went higher, it went lower. That's the average range being moved. Now you get a day like this where it opens and it runs in a single direction. We can measure the entire average range rather than going half and half, but the entire range in a single direction. So there's ADR half and there's ADR full. When a market opens and it runs in a single direction, we want to use the full ADR. And when the market opens and it's going in both directions, we're very likely going to use the ADR half. The thing is, we have them both on the chart, right? So we can first consider, is today a normal day, a day like any other day? And if it is, we're going to go to the red line and we're going to stop. We'll go to the red line and we'll go back the other direction, right? That'd be the ADR. If it's an uncommon day, we'll open and we'll go an entire ADR in one direction. Now, on Thinkorswim, I've never had a chance to show you guys what it looks like in the past, because we always get a new set of bars every day and there's no history. And I have yet to figure a code out that'll work the way I want it to show you past examples. But we do got it on TradingView, which is why I encourage you guys, download this indicator and look at what price does around these levels and how that level very often is the end of the move, unless we're doing a crazy day, a very strong day where it just keeps driving and driving and driving. Because if we get through the red and it's still going, oh, we're very likely going to the next line, to the yellow, to the full ADR. And on those really wild days, when we get above the ADR to the full ADR and keep going, that's a really extreme day. Now this is SPY, so we want to go to the ES. The way that this tool works on the on equities like SPY is not the same way as it's going to work with the futures, and I use it on the futures. So there's an ADR full. Once it rejected, it started moving back the other direction, and along the way started to make the decision that it was going back to the ADR half. On Thinkorswim, it actually got there. It reached all the way back to the full ADR half. There's times where we hit both in the same day. We hit the bottom one and then we hit the top one. Why? Because it's the average range. It's what price does on an average basis, hits one side or both sides. So there's a lot to work here, and I'm trying to put some stuff together for some videos, but it's fantastic. We've never had the opportunity to look back to be able to showcase just how absolutely useful and powerful this indicator is. It is a part of my trading day. Every single day I focus on this. Where are we at in relation to it? Are we above it, below it? Are we still in the range? Because when we start moving towards it, we're going to it. It's nice having a destination like that. It really assists in the trades, right? When you've got a destination in mind. So to find it, just go to indicators, type in ADR multi. It's this average daily range multi time frame. It's by Arun. I'm not even gonna try to pronounce the last. It's got over 1,000 downloads, so you should be able to find it. Now it does come with multiple time frames, so you can set it to weekly and all kinds of things, which is fantastic. I just haven't done that. And then it has moving averages built into it, which is fine, I guess. Whatever, I don't care. So I did check it. The math is the same. The difference, from what I can tell, is that each broker kind of marks a different close. Maybe it'll be at 4 o'clock, it'll be at 4:01, right? That's what's throwing the thing off, is how it's closed or where the market considers the open to be. Up a couple of ticks off on different brokers gives it a couple of ticks off on the range. Also with the math, it averages the highs and then it averages the lows and then it puts those two numbers together. On Thinkorswim, I put the two numbers together and then I average it. So that throws it off slightly. But, you know, it's not a line in the sand anyways. We wouldn't trade it to the tick perfect anyways. It's more of discretion of where we at, above it, below it. Are we going towards it? Are we going away from it? So it's fantastic. I can't wait to get some videos done on this thing. All right, net gas is down. Bonds are down. Precious metals, gold, the China constituents, those China ADRs, BABA, Baidu, JDD, PDD. Bitcoin is up more than 3.5%. The financials, so KRE, regional banks, are up. And energy, vaguely, the generic energy, XLE, financials, XLF, and XLI, because it's close enough. So industrials, building materials, financials, energy, that's a mixed bag. But what stands out is it's not tech. Now we've seen Bitcoin correlate strongly with the NASDAQ earlier in the year. They were running at a 70+ correlation. So seeing Bitcoin up like that without tech, without the NASDAQ, implies that one of those is wrong. Either Bitcoin's going to fall out or the NASDAQ's going to catch up. And I said the same thing about the indexes. The NASDAQ is dragging its feet. The S&P and the Russell and the Dow are doing better. So either the NASDAQ is warning and leading to the downside and the others just haven't caught up, and that isn't playing out, or the NASDAQ is the laggard and it isn't coming into play yet. Again, it's very likely because of Apple, right? There was some news about Apple and its lack of selling of iPhones in China. Now, China is not exactly Apple's dominant market anyways. But according to analysts, that's where a lot of analysts were looking to see Apple grow, right? So if that's Apple's emerging market, then they're failing miserably at emerging there. Be a good way to look at it. So it is up a little bit, but if you've seen my CPI and PPI and non-farm payrolls discussion about a gap close play, the fact that we're trying to come up off of that low looks very much like we're just trying to come up and close this gap. And yeah, I know you don't see a gap, you see a candle, but it's a liquidity gap. So this really just looks like a reflexive move back to close the gap. It doesn't imply that Apple's done falling yet. What you do want to look for today is when a company like this gets a negative news report, gets whacked in the news, and they rally through it, that's crazy bullish. And we've seen it before, so it's not like only Apple can do it. When companies get a bear report, or they get a negative news press and then they get downgraded and they rally, that's a strong rally. You want to buy into those, at least for a trade. So it's what I'm watching for with Apple. Let's start with just getting it back inside yesterday's range, so back inside of Friday's level. From there, we can focus on Friday's 50% mark or its Globex low, and then we'll focus on Friday's open, Friday's high, and then breaking out of last week's range. So step by step, level by level. I don't think it's got it in it, right? So I'm not suggesting that that's what Apple's going to do, just that if it does throw this report off, because right now it's just analysts chipping teeth. If they throw this off and do push through it to the upside, then that's the levels we want to focus on. All right. In the S&P, we have 3 names above 1%. Colgate, CVS Health, and Raytheon. So not a lot of no tech, right? No tech, and that's not enough to make anybody all warm and fuzzy. S&P with names that are above 0.5%. This cleans things up a little bit. We could see some finance in there, some technology, but it's old tech, aerospace and defense. That's not the kind of tech we're looking for. So when it comes to any sort of rallies, we got to have risk on sectors: finance, technology, consumer discretionary. It's always got to be at least one of those 3. And honestly, the argument can be made that finance can't do it by itself, even if consumer discretionary comes in to help, that it really just can't do it. So if we only have finance and consumer discretionary, it's going to be a choppy, violent day, and there'll be a lot of divergence between the NASDAQ and the S&P, because the NASDAQ 100 doesn't have financials in it. So it won't get the assist, which is what we're seeing right now anyways, right? NASDAQ's, having a rough morning, and the S&P isn't. So 23% of the S&P is up 0.5%. But only 5 names, or 5%, is down 0.5%. So we're more bullish than bearish. We're just not overly bullish. And that doesn't bother me, by the way. I don't like a Monday where we're crazy gapped up anyways. I'd rather be gapped down, honestly, but whatever. So for the NASDAQ, I would say that this isn't screening the way it's supposed to. Something's wrong with that filter. Yep, that would do it. Two names in the NASDAQ are up 1%, Lululemon and Teams. Neither one of those really excite. and 9% of the NASDAQ is up 0.5%. Fortnite, Teams, none of these are looking really good, right? Railroads, Costco. So the big takeaway from all this is we need big tech. We need those magnificent 5 or those magnificent 7. The market can run without those, but you would literally need the other 95 names out of 100, right? If you're not gonna have the magnificent 5, you would need all of the other 95 to pitch in, and that's just not what we're seeing this morning. So there's some of that divergence. Microsoft up 0.5%, but Apple down 0.75%. Nvidia down 1%. Tesla down 1.25%. Those are some of the FANG names, and you can tell that they're one of the FANGs just by the size of the box, right? That's how this grid is built. Market cap kind of is implied by the box size. So out of all these FANG names, Microsoft is the only one that's even remotely doing good. Amazon's up, but not up enough to hit the benchmark. The benchmark is a 0.5%. Google and Meta is kind of flat, so really no argument from them either way. Now, unfortunately, it doesn't let me sort an S&P 100. It only gives me an S&P 500. So my solution to that is to use the filter and just sort by market cap and try to get that thing as close to 100 names as you can. So here's 111 names. This is close enough. And now we can see those FANGs standing out. We can see what is doing good in the S&P. Health services, energy and materials, some finance, a little bit of transportation, utilities, industrials. So a good start. Bitcoin and pot stocks are dominant this morning with small caps, IWM right behind it. Remember the first of the year, January, February, March, it was a small caps extravaganza. I mean, that's really what started the year off. So, as much as everybody kind of pokes at the small caps, they have their purpose. We're going to very likely see a lot of bottom fishing, penny stock, dash for trash junk liven up a little bit. Might want to look at things like ARK, for an example, Kathy Wood's flagship product, or maybe any of those ARK constituents, right? Because there's like ARK Genomics and all the other proxies. So I'm looking at MSOS here. We can see all that selling around 7.25. If we get through that, say get above that 7.5, I'd say that this could make a ranged move. Just measure the entire range here, plot it up 50% and then 100%. Should easily give you 8 to 8.5, not in one day, obviously, but so really wide at TRB. Just be careful because this is making like classic island zones, right? Like gap down, had a leg here, or just perfect zone, gap down again, new zone. It's digesting this move, right? This really big, massive move. Thing is, I think we're getting close to that 50% mark too. So if we half back, always a question of whether or not we want to do that wick. I'd say we don't. It's like a blow off top, little hoorah there. It's not worth marking it. We're at the halfback spot. So if we are digesting this move and that we're at the halfback, this would be, if we were going to rally, making sense to rally from here. Starting with IX10 getting out of this box. Just remember all of these small cap things, these are like event driven stocks, right? TA on small caps, well, especially penny stocks, doesn't function very well because those things move event driven, not patterns and analysis driven. All right, it's like the Dixies on autopilot here. We're just that consistent, persistent sell-off, but it's not extreme and it's not fast and violent, which is fine. It's exactly the kind of move that we want, right? We want this thing to head to the downside and we don't want it to make any sudden moves. Nice and easy, nice and clean. It's exactly what we want to focus on. So US dollar Japan, on the other hand, right now we're looking at a daily chart. We're still caught up in this candle here. So we want to focus on 50%. 149.33. As long as we're maintaining above that level, then we can still consider this having the capacity and the potential for a continued move up. Did some reading over the weekend about the size of that intervention last year. They actually had two on that October low. There was one on the 21st, and then there was another one on the 23rd. One was on Friday, and then they came back in and hit it again on Monday. They double tapped that sucker, made sure, they killed it as dead as they could kill it. And it did a pretty decent job of it. When they stepped in and did that move that day, the Dixie went from 149.70 to 145.20 in minutes. We're talking about the Dixie dropping like 5 points or 4 points in minutes, right? So this DXY, it's made this entire move here, which is 30 cents, and it took all night. In that intervention, it moved over $4.50 in a few minutes. That'd be like going from 106 to 102 way down here in a matter of moments. So that's the kind of moves that we're still expecting if US dollar Japan continues that run to the upside. So, when people are asking, what do you think about the S&P, where we're going to be at the end of the year, blah, blah, blah. This intervention is still on the table. There's still a real threat that Japan's going to have to do that. And if we see the dollar fall that far, that fast, the expectation is going to be for an S&P to rally like crazy. And it didn't talk about it much in that article, but You know, the move that was happening in the 10-year that day was extreme too. So you get the dollar falling, you get the 10-year falling, you're going to have the expectation of the S&P making some drastic, significant moves to the upside. And it was, right? It moved 1.5% in 90 minutes. The S&P 1.5% in 90 minutes. That's a big move. It's not going to happen today. We're sitting at 149.5 this morning in US dollar Japan. So no threat, but we are coming down into the support level. We want to see if it's going to hold. And if it does and continues making that move to the upside, then that threat is still on the table. Another worry for another day, right? Lots of Fed speakers today. Just keep that in mind. The market has had a rough week. It wants to digest some of this news. And from a technical analysis standpoint, if we're using pure price method, then we're in a confirmed downtrend. And until that changes, that's just what we have. So using Linreg here, you can see how we're on the upswing, but it doesn't owe us much swing before we're heading back down again. If we were to, you know, kind of reach back to this low here from October and run it to that peak, that move is done. Put it on a daily. You can see we're on the downswing here. Now it's just math, right? That's all it is, just math. The mean is down here, 140, 429.24. And we do have a gap to close on the ES, on the SPY. That's what I got for you guys. Be careful, be safe, keep your eye on the clock, watch the news, right? Those Fed speakers, they're going to be your biggest threat today. Retail sales, you know, I mean, there's a lot that's going to be coming out this week between earnings and this data that we've been waiting for. So kind of tread lightly, but look for all of this to really start playing out. I think the market's done being tippy-toe cautious. So we'll see. I'll see y'all tomorrow.